Welcome back. Well, let's talk markets and discuss the way forward, considering we've entered a fairly volatile zone now. Pramod Amthe, head of institutional equity research at InCred Capital, is joining in. Pramod, great to have you with us on the show as always. Thanks for being with us. Lots to discuss, Q3 earnings, valuations and whatnot. But let me start with the hottest subject, the volatility and the shakeouts that we're now beginning to get in the mid-cap market. What have you made of it? And is there a risk that we could actually finally get a bigger, deeper mid-cap correction? I mean, what's top of mind when we're looking at this part of the market?
I think mid-caps have been on tearing hurry, right, for last couple of months, where which is more pronounced now in the way the lesser liquid stocks have been moving much faster. So that was giving a lot of discomfort, along with the relative valuation of mid and small caps on a forward P, which is anywhere at a premium of around double digit versus the broader Nifty index. So I think that was also widening up. So in that relative basis, we have been conservative on mid and small caps, and that was expected to play out on a downturn as and when I would say policy interventions happen for creating a sufficient liquidity or any of the political uncertainties as they come through either by the global markets or the domestic markets. So I think that is only playing out in the short term. So the preference remains for large caps, which we have been saying for the last couple of months. And similarly, we have been adding up more on the high conviction, more large caps as compared to mid and small caps.
Right. Pramod, good morning. Thank you so much for joining in. I was just going through your high conviction list, and it features 6 Nifty constituents, which includes HDFC Bank and SBI as well. You guys are overweight financial services. I had to ask you this. Almost every fund manager or every market analyst that we speak to, they are finding value in large private banks, but they are just not willing to perform at this point of time. How long does one stay with that hope that, okay, there is value, but also live with no returns for a prolonged period of time?
No, I think it's more about relative, right? Whether you want to participate at this level in the correction phase, you want to protect the capital, or you want to participate on the correction in capital. So in that basis, the large caps definitely give a valuation comfort, and more so in terms of the catch-up which is happening in the best of the PSU banks rally seems to be there, even though we like only the name there is SBI, which we added into high conviction somewhere around December, as we feel that the policy risk, which has been talked about, is over discounted at the current valuation. I think the key thing to watch out is when the cost of funds should stabilize for the larger private banks, and the NIM should come into comfort, because the credit growth has been relatively healthy for the overall sector. So that's what we are trying to look at in financial services. Even though we have been overweight on the sector, we have been selective on names. As you rightly pointed out, we are only having SBI and HDFC Bank in the high conviction list on the large caps. In the mid, we are looking more for Mahindra Finance and Shriram Finance, which are the names which we are comfortable. Shriram also we added up only, I would say, in Jan or so, to adding to the substantial momentum seen in the case of the credit growth, and also the non-vehicle loans being distributed through the vehicle loan portfolio, which is giving them a much stronger momentum and the bottom line traction for Shriram Finance.
Okay. Pramod, just give us a sense of, some of the changes that you've been making to the portfolio, because I believe that you were very optimistic on real estate for a while, but it seems that you're taking a more cautious approach now. That one I picked up from the note. And any other sort of changes that perhaps you're looking at or considering, given the huge run-up in the market in the last few months?
Sure. So your observation is right. The real estate theme as an investment theme we have taken out from the strategy after nearly a 70% run in the last 6 months per se. Because of 2-3 reasons. One, clearly now post the substantial demand pull in the festival period, the base is pretty large. Having said that, going forward, the home loan rate seems to prolong at a higher rate for some more period to continue. So the K-type of a recovery or the demand trend may only extrapolate. So the lower side is still under stretched, only the top end seems to be performing. Also, interestingly, the inquiry levels on the real estate websites have been relatively sober even in the festival. If I'm not wrong, they are down around a double digit on a QOQ basis, which concerns. Building materials, which are like, if you look at the either tiles or to that extent plies, they seems to be on a weaker wicket in the December quarter, even though there is a hope that they should come back. So there are mixed signals in the real estate space, and we feel the valuations are relatively played out well, and the risk reward is not in favor. So we have seen a couple of downgrades within our coverage, and we thought that it's the right time to move out of that space. That's one. Second, the other sector which we have been conservative in last couple of months, which is the right time to reiterate, is around the election, is definitely the construction space. We are more playing tactical there, in the sense the short-term order inflows should be challenged till the new government settles in and comes back to business. So next 6 months are going to be patchy in terms of order inflows, which has been the case traditionally during the election period, which will weigh on the FY25 performance on sales. And hence, we are more underweight on the construction sector in the short term.
So, but what about IT, Pramod? It was an underperformer last year. It's not done very well this year as well. There is still this looming uncertainty about a recession in the US. Managements are saying that, okay, FY24 will be a washout, but FY25 will be better. Your conviction list features names like Tech Mahindra over companies like Infosys, TCS or HCL Tech. What prompted you to choose a Tech Mahindra over these names? And it also features signed DLM. So if you can talk about both these, the rationale for both of these names.
Sure. Tech Mahindra, I think clearly more about the turnaround story, both in terms of management change, one, and also the normalization of the business versus the peers in terms of either the sales force performance or in terms of delivery of the cost structure similar to the peers. So that's what we are trying to look at. So the first leg is going to be more about margin normalization, and second one is to be sales productivity, bringing the momentum to the top line. So hence we feel that it can relatively weather the headwinds better based on the management change, and that's why we added it in a couple of months back into a high conviction list. So we are selective on IT. The reason why we are looking at signed DLM is more on the EMS story. Clearly, the post the Israel-related turmoil, the defense spending globally is going to come through. So we have three names in our high conviction list on the EMS come defense-related names. So definitely the one name is signed DLM, where we feel that the spend on the relative basis should be better for them to play out, which I think is working out. The other defense names which are comfortable is more on BL and data patterns. These are the two other names which are similar themes.
Right. Pramod, just a very quick follow-up on Tech Mahindra. Since you mentioned the normalization of the business compared to peers, Tech Mahindra's CEO just spoke to us at the Mobile World Congress, and he was mentioning that they are still not seeing any green shoots in the telecom business, and telecom is the largest vertical for Tech Mahindra, contributing almost 40% of its top line. Do you still believe that FY25 will see some normalization in the business, because the management itself is not confident at this point of time?
We are not looking on the top line momentum. I think that headwind will be there for the rest of the sectors too. And you are right in the telecom. As I indicated, the first one is getting the cost structure right and trying to get the margins on a relative basis, which are substantially lower versus the peer, to come back to that. And the second leg is more to be getting the new business, non-telecom based, which should be a driver for second half of FY25 and more about FY26. That's how we are trying to structure the Tech Mahindra story.
Right. All right, Pramod, thank you so much for joining in and sharing your views on the markets and the sectors that you are betting on at this point of time. Time for a short break here on Trading Hour. Back with a management conversation. The management of KFin Technologies will be joining in on the other side. Stay tuned. We'll be right back.